Hello, and welcome to our latest quarterly investment briefing. My name's Mike Deverell, and I'm partner and investment manager at Equilibrium. Now, we run these briefings every quarter, and we tend to go through a similar agenda each time. We're going to look at what the returns have been of the various different asset classes that we might invest in. We'll look at what's going on in the economy, and we'll tell you what we think the outlook might be, both for the economy and the markets in the future. We'll look at how portfolios are positioned and how we're changing them and adapting them to the changing market conditions. And of course, we'll look at what returns have been like. Now, the presentation itself is about 45 minutes or so. So I'm going to start today by looking at what some of the various asset classes have done so far this year. And it's probably fair to say it's been a pretty challenging period for most investors. The exception to the rule, however, is the FTSE 100. Large UK-based shares have actually done pretty well, up 2.88%. So not like set the world on fire, but not been too bad. So if you put all of your money in the FTSE 100, you'd have had a reasonable start to the year. And we, of course, invest some of our money in the FTSE 100. In particular, we have defined returns products, which are linked to that index. But outside of the FTSE 100, pretty much everything else, frankly, has gone down. Large US shares, the S&P 500, are down 4.7% up to the end of March. Corporate bonds are down 5.8%. Corporate bonds are meant to be low risk, remember. It's quite a long way for a low risk asset. Emerging markets are down by 6%, but gilts are down even further, down over 7%. Gilts are meant to be a risk-free asset, according to some people. And if you've read my latest edition of the Pulse, actually, since I produced this data, because the data in this presentation is mainly to the end of March, actually gilts have fallen even further, and they're down over 9%. Unbelievable, as I say, for a supposedly low-risk asset. US tech stocks have done even worse, down 9%. But here in the UK, I said the FTSE 100 has gone up, the top 100 stocks, but the next 250 largest companies in the UK have gone down. But not just gone down, they've gone down a long, long way, 9.5% down. It is very unusual that you see such a big gap between the FTSE 100 and the FTSE 250. Smaller UK shares have done even worse. So if we look at the AIM market, it's down by 14%. So that's not every asset class out there, of course. That's not a non-exhaustive list. But these are some of the major ones that you might see in any portfolio. And we invest in all of these asset classes and quite a few more. And so unfortunately, what that means is our portfolios so far this year have also fallen. It's a kind of a fact of life in investing, unfortunately. Sometimes there are periods when markets go down and therefore the portfolios go down. What I thought I would do, just to put it in context, is I'll put the returns of our portfolios so far this year into this table. It's a little bit messy, but again, I think it gives some nice context for what returns have been like. Our defensive portfolio has fallen by 2.5% so far this year. The cautious portfolio is down just slightly more than that. Balanced portfolio down 3.5%, and the adventurous portfolio down 4.25%. So that's not nice. We don't like it when portfolios go down. We hate it, obviously, in fact, as I know you do as well. But in context, you can see, for example, all of them have fallen less than the S&P 500 and less than corporate bonds, for example. Our global equity portfolio, our riskiest portfolio, has gone down a bit more at 6%. That's less than emerging markets, and it's less than gilts, tech stocks, smaller companies. So in context, you can see probably the reasons why we're not having a particularly fantastic start to this year. So what's going on? Why are markets in all these different asset classes all down so much? Well, perhaps you might immediately, your mind may turn to what's going on in Ukraine. But let's just have a look at two of the markets, the FTSE 100 and the S&P 500. And we'll look at kind of, if you like, the journey they've been on so far over that period. And if we mark on here where Russia invaded Ukraine, you can see that the red line, which is the US stock market, was already 10% down when the invasion happened. The FTSE 100 was slightly up at that point, and both of them then fell, and the S&P 500 fell a little bit further, and the FTSE had a very sharp sort of 8%-ish drawdown before then recovering. But you can see both markets have now recovered. And actually, since the date prior to the invasion, certainly up to the end of March, equity markets gone up over that period. So the situation in Ukraine isn't in itself the reason why markets are down. It is adding to some concerns, and I'll come on to that in a moment. If we look at bonds over the same period, the blue line on there is gilts and the red line on there is corporate bonds. Again, you can see both of those asset classes were down prior to the invasion. Actually, just soon after the invasion, they had a mini spike back upwards, a little mini recovery, which is often what you see when equity markets fall because they're worried about the outlook. Bonds often recover. So we had that temporarily, but then as equities started to recover, bonds have resumed their downward slide. And before I come on to the reasons why that's happening, it's just worth looking at some really odd effects that we're having. Because as I said a moment ago, bonds are generally seen as relatively cautious, but in a lot of cases, they are down more than equity markets. And so what we're seeing is some cautious funds are really struggling. I've just picked out two of the Vanguard funds. The Vanguard invests in index tracking funds. They have very low cost passive funds. The red line is their Life Strategy 60% equity fund. That has 60% in equity, and it therefore has about 40% in bonds. The blue line is their supposedly more cautious fund, their most cautious fund that they've got. It's only got 20% in equities, but it has therefore 80% in bonds. And it's very interesting to me to look at the more cautious fund is down quite a lot more than the more adventurous fund. It's down over 5%. So if I was a Vanguard customer, I would be probably a little bit unhappy if I was in the cautious fund to find myself with a much steeper loss than the more adventurous fund. And we think it's important that funds behave in a particular way that's relatively predictable. So I want to just, before I come on to what's happening in the markets, why we're getting these sorts of losses, just look at how our funds have been behaving, our core funds, our cautious, balanced and adventurous funds. And these were all launched in 2017. What we're looking at on this table is each individual calendar year since we launched the funds. I'm also looking at what returns have been like this year, and this one's slightly more up to date just because I produced this table for the Investment Management Committee in mid-April, so this one's up to 11th of April. We're comparing the funds to the average mixed investment 20 to 60% shares sector. This is the sector that Financial Express, who's our data provider, groups all of our funds into. It groups them with all other funds that are allowed to have between 20 and 60% in shares. So we use that as a kind of informal benchmark to see how we're performing. I want to highlight cautious fund initially, and let's have a look at two periods here in 2018 and 2022 so far this year. Both of these are negative periods, periods when markets have gone down. What we want to see from cautious is that it goes down less than the rest. We're not going to be able to avoid losses completely, but we want to make sure that the cautious fund is our most cautious fund. And that's what we see there. You know, in 2018, it outperformed the mixed investment sector. Green numbers are where we outperform, red numbers are where we underperform. So in 2018, it outperformed, and it's outperforming so far this year. That's what we want to see. The flip side to that, of course, is because it's more cautious, if markets go up strongly, it can underperform, like we saw in 2021. Adventurous is meant to be the complete opposite. Let's highlight, again, this year and 2018. Those numbers are in red. Adventurous has fallen more than the average mixed investment fund this year, as it did in 2018. But frankly, that's not unexpected. We are deliberately taking more risk. It's towards that sort of 60% equity part of the range. So we're deliberately taking higher risk, which does mean when markets fall, our portfolio can underperform. But the flip side to that is when they go up, we tend to see that adventurous outperforms and outperforms hopefully quite strongly. So that's the sort of behavior you should expect, that when markets go down, cautious will fall a bit less than balanced, and balanced will fall a little bit less than adventurous. But then the opposite is true when markets go up. We're really pleased that balanced so far has outperformed in every single calendar year since it was launched, and has outperformed so far this year too. So I still haven't answered the question, what's going on? Why are all those asset classes down? Well, directly or indirectly, it's all about inflation. And this is the best GIF I could come up with for inflation. I need to keep searching. I'm sure I'll find a better one eventually. We've all seen the headlines, you know, CPI inflation here in the UK is 7%, very, very high. We're all seeing the worries about the cost of living crisis. And, you know, I think there are reasons why we should be concerned, absolutely. So, and then we talked about inflation in previous briefings. There are lots of reasons for it. A lot of them are temporary, and I think they're related to the pandemic. Essentially, as markets or economies have reopened, demand has recovered, but supply is still failing to keep up. So I think that's temporary. But in particular, what you're seeing at the moment is a big spike in commodity prices, in particular energy prices, which is having a real feed through into inflation. This chart is looking at the oil price just over the last 12 months, and it's up 84%. It's a long, long way over that period. Again, I've marked on when Russia invaded Ukraine, and we did have a very sharp spike in oil. At one point, it got to 120% up, but it was already 60-something% up prior to the invasion, and it's since settled back down a bit. Oil at the moment is about $100 a barrel. It did get as high as sort of 130 or even higher. So that, of course, you know, affects everything. It's not just what your petrol costs, but that then has a knock-on effect to all sorts of other prices. We're also seeing a similar thing in other types of energy, in gas and electricity markets. And this is from the Ofgem website, and it's looking at the default price cap, the maximum amount a typical user would have to pay for their energy. And back in 2020-21, the winter, that was just over £1,000. And as of today, the price cap for a typical user is more like £2,000. So it's basically doubled in 18 months, which is really quite, you know, astonishing. And that is going to have a real effect for a lot of people. That's going to, you know, make people are going to struggle perhaps to pay their bills in some cases. And if we look at transport and household bills alone, they basically make up about half of that headline level of inflation at the moment. So where's inflation going to go from here? Well, frankly, I think it's extremely difficult to try and forecast. As I said before, I do think a lot of the things that are pushing inflation up are temporary, related to the pandemic, and then hopefully, therefore, should at some point get back to usual. But if we want to forecast what's going to happen to inflation, we've got to forecast what's going to happen to those commodity prices. And frankly, you know, in order to do that, we would have to forecast what's going to happen in Ukraine. And I have no idea. I have no more idea than anybody else. So I think we should acknowledge what we don't know. Yes, I think there's reasons to think that inflation could come back down, but we should be wary of it. But I do think it is worth putting it in context. I said the oil price was up 84% over the last 12 months. But if we look at over 10 years, oil is actually down 9.6% so far over that 10-year period. So at one point, it was 80% down. So is it at the moment, as I said, it's about $100 a barrel. I think there are reasons to believe it could easily be $80 or $90 a barrel this time next year. If so, that would be deflationary. You could easily also make a case that it might be $120 a barrel, and that would be inflationary. So it'd be very, very difficult to forecast, but I just think it's worth putting in context. Let's also put that overall headline inflation number in context. This is looking at what CPI inflation here in the UK has done over the last decade. The dotted red line on there is the Bank of England's target for inflation, which is 2% per annum. For a lot of the last decade, inflation has been below 2% per annum. We've even seen it below zero back into 2015, and even just sort of 18 months ago or so, it was only about 0.2%. So again, worth putting that in context. Inflation has spiked up. I couldn't tell you whether we are going to continue to see higher inflation from here or whether it will come back down. Not with any degree of certainty. I suspect it will come back down, but we can't bet portfolios on a suspicion. We don't do bets. We do asset allocation and we do sensible portfolio management. But one thing we can say is that if inflation is higher than the Bank of England's target, then there's a very good chance that they'll put up interest rates. They've already started to do so. And this is what the markets currently expect is going to happen to interest rates here in the UK over the next few years. We're currently at 0.75% per annum. Markets expect it to perhaps get to 2%, base rate at 2% by the end of this year, and maybe even as high as 2.5% by midway through next year. So this is the main thing that is worrying markets. It is the main reason why certain equity markets have fallen a long way. And it's certainly the reason why bonds have done very badly, because bonds pay a fixed level of interest. We always look at bonds in terms of the yield. And this is what has happened to the yield for the UK gilt, the UK 10-year gilt, which is the orange line, and the US 10-year government bond in blue over the last 6 months. The yields have gone up a long, long way. The gilt yield back in December was 0.75% per annum. It's now 1.75% per annum. Back in December, a US Treasury bond yielded 1.5%. It's now 2.7%. Those are some very, very big moves for bond markets, which tend to be quite sedate and boring. And as I said, because the yields have gone up, yields have to go up to reflect future expectations of interest rate rises. But because bonds pay a fixed level of interest, the only way a yield can go up is the price goes down. And that's what we're seeing. And we do invest in fixed interest, particularly in some of our more cautious funds. And so that part of the portfolio has struggled. We're looking at here is our fixed interest portfolio. There is the green line on this chart. The orange line is gilts. So it's done better than gilts. It's not fallen as much, but it is still unfortunately down this year. However, what we've been doing in the portfolios over the recent times has been allocating less to fixed interest and more to what we describe as real assets. Things like property, which is the red line, and infrastructure, which is the blue line. And these have done much, much better. They did fall in January and February because they are directly listed on the stock market. So whilst you own a building indirectly with the property portfolio, for example, it is listed on the market. So it does sometimes get caught up in the volatility. But you can see that it's actually recovered really nicely since the lows in early March, and actually infrastructure has done even better. What these two assets have got in common, or these asset classes have got in common, is they're backed by something real, something physical. In the case of property, it's backed by a building. In the case of infrastructure, it might be a wind farm, it might be a toll road, a railway, or some other type of utility. What they've got in common is that they tend to receive a fairly solid, steady income, whether that's from rent or from selling electricity, for example. And that income tends to go up with inflation. It gives you some inflation protection. So I said, whilst I think inflation, I'd like to believe will come down, it won't remain at these very high levels for the long term. We need to make sure we've got inflation protection in the portfolio. And one of the ways we do that is put more money into these real assets, which have done pretty well so far this year. So onto equities, and we knew that there was a very good chance that central banks were going to have to start putting up interest rates this year. And so we've done lots of research into what types of equities have historically done well in that scenario and which types of equities have done poorly. This chart is from JP Morgan. I showed it in the January briefing as well. And it looks at all the different types of equities and how they've tended to do in periods when bond yields have been going up. If we look from the top downwards, we see that small cap stocks have historically tended to do the best when bond yields are going up. Value stocks have also done well. I'll come back to what a value stock is in a minute, as has Japan, Europe, and the UK. The areas at the bottom are the areas that have tended to underperform. So growth stocks, such as a tech stock, large cap stocks, the US, emerging markets, and China. All those areas have historically underperformed in times when bond yields are going up. So we look at data like this and we use this to try and give us a guide to what might happen and adapt the portfolios accordingly. But of course, this is historic data. It's what's happened in previous periods. So how is it working so far this year? Well, if we look at value stocks in blue, they are indeed outperforming growth stocks in red. A value stock might include at the moment something like an energy stock, a commodity stock, a bank. Lots of those in the FTSE 100. A growth stock might include a technology company, for example. So what a growth stock is, the reason we call it growth, is because these are stocks which generally are a bit more expensive than lots of other stocks on the market. If we look at current earnings, they would be valued at a higher multiple of current earnings than the market as a whole. But it justifies that higher premium valuation because we're expecting higher levels of growth. We're expecting those earnings to grow much more quickly than the average fund on the market. A value stock is completely the opposite. It's a cheap stock, valued at a low multiple of current earnings. And the reason for that is we're not expecting a great deal of earnings growth in the future. So value stocks historically have done better in rising rate environments, and they have done so far this year. So what we've done in our equity portfolios is we've tilted more towards value and less towards growth, and that has helped. Clearly, hindsight, we wish we'd done a lot more, but we never know for certain what environment we're going to go into. We suspected rates were going to go up, but we never know exactly what's going to happen, so we'll always try and have a mixture of different asset classes in the portfolio. What about some of the other things? Well, one of the things the data said was that emerging markets ought to underperform developed markets. And that has been the case so far this year. The blue line, emerging markets, has underperformed developed markets. Interestingly enough, they were doing better than developed markets until the invasion of Ukraine. Obviously, that's had a knock-on effect to Russian markets, but also Chinese stocks, for example. People have got more worried about geopolitics in general, and Chinese stocks have actually also been hit hard by the fact that they've got some more lockdowns in China as well. But that is probably not unexpected in a rising rate environment. However, if we look at small caps, which remember the JP Morgan data said historically do the best in rising bond yield environments, that has not been the case so far this year. As I said at the beginning, the FTSE 100 is up. This is just looking at UK stocks, but the mid-cap index, the next 250 stocks, is down 9.5%. And the AIM market, smaller companies, is down even more. So smaller companies have not outperformed large companies, as we've historically seen in times when interest rates are going up. And we see that elsewhere. We can see it in particular in technology companies. This is out now looking over the last 12 months. The blue line on here is large US technology companies. So that might include Microsoft or Alphabet, which is Google. And over 12 months, they're up 25%. The red line on there is smaller US technology companies. They're down 1%. Same sector, same region, but a big, big difference. The green line on there is non-US tech. So, that has been unusual. And remember, the JP Morgan data said that historically, when bond yields go up, you don't want to have large US growth stocks like tech stocks. But actually, they've done a lot better. Now, things are starting to change, and they have struggled more so far this year. But some of this, what's going on in the market right now has posed more of a problem for our more adventurous funds, our global equity fund, and our adventurous fund. Here, we are taking a very long-term view. We want long-term growth. And we don't need to worry so much about the short-term volatility as we would perhaps more in cautious, for example. And so in our long-term portfolios, our more adventurous portfolios, we want to play some long-term themes that we think will really add to performance over, say, 10 years or more. One of them is that we think small should outperform large. It's just mathematically easier for smaller companies to grow more than a company which has already grown a long, long way. So we will always have a small cap tilt, if you like, in our portfolios, and particularly the more adventurous ones. We think over the long term, emerging markets should normally beat developed markets. We want to invest where the economic growth is. In particular, we know there is an increasing middle class, an increasing amount of wealth in Asia and other emerging economies. And if we can sell to those consumers, then that will probably be a pretty good investment, we think. We want to invest in technology. We think if we're going to see growth for the next 10 years, then it's going to be at least partly driven by technology. So we're looking for the next generation tech stocks, the next winners. We like things like Microsoft and Google. That's fine. We have some of that in the portfolio, but we want to find the winners of tomorrow as well. And then another long-term growth theme that we like to try and get on the right side of, if you like, is tackling climate change. We know that there's lots of money being chucked at this problem, whether that's private sector or public sector. And so we want to make sure we can benefit from that as we're trying to find new technologies, for example, to tackle climate change. So how are they performing short term? Well, tackling climate change as a theme has been a positive. That's one of the reasons infrastructure has done so well, because we've got lots of money in renewable technologies. That has actually benefited from the situation in Ukraine as governments start to look at ways to shore up their energy markets and remove their reliance on Russian gas. One of the ways they're looking at that is renewable energies, but we also have other types of energy related infrastructure in those portfolios as well. So that's been a positive. But the other themes, frankly, so far this year have not been a positive. We've seen short-term underperformance for all of them. And as I said, that's one of the reasons why perhaps our more adventurous funds and our global equity fund have not done as well as we would like to see this year. So should we change them? Should we be changing our approach? And we don't think so, because as I say, we're long-term investors. We look over the very long term. This is 20 years. Smaller companies in the UK, FTSE 250 has done nearly 500%. That's the red line. The blue line is the FTSE 100, just 200%. So 20 years, where would you want to be, small or large? Over 20 years, emerging markets, which is blue, has done 464%. Developed markets in red, up 382%. So if we're taking a long-term view, which we do particularly in adventurous and global equity, we want to have a decent chunk in these areas. And yeah, that may unfortunately lead to short-term volatility. But why have some of the things that historically done well when interest rates go up, why have they not done so well this year? For example, the smaller companies. Well, one of the reasons I think is that investors are worried about stagflation. We have stagnant growth and inflation at the same time. That's quite an unusual combination. Usually when we've got high inflation and when interest rates are going up, it's because the economy is booming. And that's why smaller companies tend to do well, for example, and why value stocks tend to do well in a rising bond yield environment. But right now, people are worried about slowing growth. Number one, we're just likely to see growth slow as we the sort of effect, the reopening effect, starts to wane. We had very strong growth as economies reopened after the pandemic, and that just naturally starts to tail off. Here in the UK, we had the Omicron variant, and that then we had the Plan B regulations, and that led to a short slowdown around Christmas. And now we have worries that the inflation itself could impact on the economy. And this is why, this is from the Resolution Foundation. This looks at the change in real household disposable income, and it looks at it each individual year going back to the 1950s. So normally disposable income grows more than inflation. That's when you get the blue bar. And that means people have more money to spend and the economy can grow. Occasionally, incomes don't keep up with inflation. That's what we saw in the 70s there. You can see in the 1970s a couple of red bars because we had very high inflation. We had some red bars in sort of early 2010s, more because of slow growth after the financial crisis. And we also saw real incomes fall in 2016-17 after Brexit. But if we look across there, the forecast for next year, or this year coming, is the worst of any year on there. So real incomes are expected to shrink over the next 12 months. And if we've got to spend more money on our bills and our filling up our cars and food, then of course that means we've got less money to spend on everything else. And so that introduces worries that the economy might be about to slow. And so if I come back to what I said earlier about interest rates, they're expected to go up very steeply in the next year or so to combat inflation. But interestingly, they're also expected to then come back down again. They're going to have to be cut, perhaps because the economy might slow. That's the UK picture. And we see something very similar in the US. Now, if you've been reading the financial pages of the press recently, you may have seen headlines about the dreaded inverted yield curve, which is meant to be a terrible signal of impending doom. This is basically what an inverted yield curve is. It's because we expect interest rates to go up, but then have to be cut again. And that has a feed-through effect onto the bond market. This is the US yield curve. And when we say a yield curve, basically all we mean is what we've done is plotted the yield of various different maturities of bonds against the maturity. Normally, the yield curve slopes upwards. So if we look at what it was a year ago and 6 months ago, that's a normal sloping yield curve. That you get a lower yield for short-dated bonds and you get a higher yield for long-dated bonds. It's called a term premium. You would expect that if you're going to tie up your money for a longer time period, you would hope to be paid more for doing so. So that's what the yield curve looked like a year ago, but the dark blue line on there is what it looks like now, and it's a lot flatter. From about 2 years onwards, it pretty much goes sideways. You don't get any more interest for lending your money for a longer period. And in fact, at least of the date I did this chart, a 10-year bond was yielding less than a 2-year bond. And that's what we mean by an inverted yield curve, that longer dated bonds yield less than shorter dated bonds. The reason why it's important is because historically, when that has happened, we've then had a recession shortly afterwards. That's what this shows. The blue line on here shows the difference between the 10-year and the 2-year US government bond going back to the 1980s. Whenever the blue line dips below the red line, that's when the yield curve inverts. Whenever that's happened in the past, it's been shortly followed afterwards by one of the grey shaded areas, which are recessions. The last time it happened was in August 2019, and that was followed in early 2020 by the COVID-related recession. Now, how the bond market knew that we were going to be hit by a global pandemic, I don't know. But we did get that recession signal even before that slowdown. So are we going to see a recession? Well, these sorts of signals, remember, they are based on historic data, and we've already seen that historic data can be a guide to the future, but we shouldn't rely on it being repeated in the future exactly the same as it's been in the past. So I think there are reasons to think that things might be different this time. The bond market is very much distorted by quantitative easing, for example. But even so, I don't think it's a signal we should ignore. There is certainly an increased risk of a recession. It's also worth remembering that in the past, when we've had these inverted yield curves, actually it's taken some time before the recession started. That's what this table looks at, loads of past periods. The average lead time between the inversion and the recession starting is 19 months. So it's not something to panic about. It's not something that is definitely going to happen, and it's certainly not going to happen tomorrow. But I do think the higher level of inflation does certainly increase the risk of a slowdown here in the UK and in Europe. In the US, the growth is a bit stronger, so hopefully they might be okay, or at least for a bit longer. But we have to start thinking about it. So what sort of assets tend to do well in a recession? Well, actually, some of the things that do well in that sort of scenario are some of the things that have been doing so badly so far this year. Gilts and US Treasuries. Blue line on here shows the gilt fund that we hold in portfolios, and the green line there is a US Treasury fund, again, that we hold in portfolios. We didn't hold them at the start of the year, but as they've fallen and as the yields have gone up, they started to look better value. And we started to just tentatively put some money in that asset class when gilt yields got to 1.5% and US Treasuries got to 2%. As they've then fallen further, they start to look even better value when yields got to 1.75 and 2.5% respectively. Then we topped up. And if they get to 2% and 3%, we'll probably top up a bit more. So being very cautious about it, but just as things start to look better value, we start to add them more to the portfolio. And it's not because we think they look fantastic. If it's a 3% yield, it doesn't mean we're going to see some hugely amazing returns. But what we do know about these sorts of assets is that in periods when equities fall sharply, often, certainly if you're worried about the economy slowing, often they bounce, often they go up. And that's what we saw in early March when equities fell after the Russian invasion of Ukraine. Bonds briefly rallied. And of course, it follows that if these bonds are struggling in periods where we're expecting interest rates to go up, in a recession, interest rates tend to be cut, and therefore bonds tend to do well. And actually, we think there are good reasons to think, because of this risk of slowdown, that the central banks won't be able to put up interest rates as much as markets have already priced in. That would therefore, we think, be good for bonds. But we're always going to be constantly rebalancing the portfolio. As things start to look better value, we want to buy more of them. If they start to look expensive, we want to hold less. And volatility nearly always gives us some opportunity to buy some decent assets at cheaper prices. This chart is just looking at 3 assets so far this year. The FTSE 100 in blue, infrastructure in green, and property in red. These are 3 assets that we decided to top up in early March. You can see I've marked on the chart when we bought, roughly the 4th of March, and all of them have gone up since then. So volatility brings opportunity to add to asset classes that we like at cheaper prices. And that is something we will always try and do. And in fact, we've carried out lots of trades over the last few months. This is, I'm not expecting you to read the whole list, but this is some of the equity and related purchases we've made in February and March. Lots of very small trades, but they add up to about 6% of a balanced portfolio. They've all pretty much made money so far. The best one as of that date was US Tech, which was 15% up. One of the property funds was over 11% up, but there's lots of 5%-ish returns on there. So volatility always brings opportunity to try and eke out some extra returns. So let's have a look at what effect that has had on our asset allocation. This is the balanced asset allocation, and I'm comparing what it was in January on the left, when we had our last briefing, to what it was at the beginning of April on the right. I think probably the thing you might notice more than anything else is the green area, which is fixed interest. That was 30% in January. It's now only 20%, or at least it was at the beginning of April. Since that date, we've started to put some of the cash, the blue area, some of that cash back into bonds. The other thing I'd draw your attention to there is the purple area, which is real assets. It's now up to 15% of the portfolio, the infrastructure, the property, the things that we think will give us protection against inflation. And equities, which is the red area, has gone up from 30% to 33% of the portfolio. So whilst there are worries about interest rates and higher inflation and a slowdown, the market's already reflecting some of that fears, and that is why markets are already down, and they start to therefore look better value, start to look a little bit cheaper, so we start to increase exposure. So that's where the portfolios are positioned today, and we think that gives us a good mix of inflation protection, but also some assets that could rally if inflation were to come back down. So let's look at returns. We already looked at what returns have been like over the last 3 months. Cautious down 2.78, balanced down 3.5, and adventurous down just over 4.25. The average mixed investment fund fell by just over 3% during that period. We look at our defensive fund. Now, our defensive fund, because it has lots of money in fixed interest in bonds, Financial Express, our data provider, groups it in the global bond sector. So we just look at that, as an informal comparator. Defensive is down just under 2.5%. Compare it to the average bond fund, that's down 5%. Global equity, as I said, has had a difficult period because it's got lots of those long-term assets, the smaller companies, the emerging markets, down 6%. The average global fund, which has a lot more kind of US large cap, is down 5% over that period. We look over 12 months, again, returns are pretty average, somewhere between 2.21 and 2.52% over 1 year. If we look at defensive, well, even though it's been one of the worst periods for bonds, what we wanted to make sure the defensive was truly defensive and at least not lose your money. And it's pleasing to see that over 12 months, it's still even marginally positive when the average bond fund is down. And global equity is up over 12 months, but it has struggled because of the reasons that I've outlined before. It's up 2%. Well, that's the short term. And as I said earlier, we want to be long-term investors. And if we look over 5 years, then we can see all the portfolios, the core portfolios, which have been running for that length of time, have all made some reasonable returns. 21% for cautious, 24.5% for balanced, 32% for adventurous, all ahead of the average mixed investment fund out there. If we annualize that, that works out as somewhere between, depending on your portfolio, just under 4% per annum up to 5.8% per annum. So the core thing that we want to do over 5-year periods is make sure that we beat inflation. And even though inflation's gone up more recently, we have been able to do that. After inflation, that works out as a real return of somewhere between 1.1% and 3% per annum. So not fantastic, but at least beating inflation and ahead of the average fund out there. But if we look over 10 years, this is much more in line with what we would expect to see. Cautious has provided a real return of 3.8% per annum. Now we try and get closer to 4%. It's a pretty challenging target, frankly, for a cautious fund, but we're near there or thereabouts. Balanced has provided a real return of 4.5% per annum over the last decade, and adventurous 5.5% per annum, real return ahead of inflation. And that's what we want to see the portfolios doing. And to sum up today, I've said there are lots of things, lots of challenges out there. Markets are wary about higher inflation, higher interest rates, and the possibility of a slowdown. But I'm an optimist, and I want to leave you with one thought. What would happen if inflation was a little bit lower than people are expecting. Perhaps commodity prices came down. Perhaps there was a resolution in Ukraine. If inflation was lower than people expected, central banks wouldn't be able to put up interest rates as much as people are currently expecting. There would be less chance of an economic slowdown, in my view. And I think that is perfectly possible. And if that happens, therefore, I think equity markets could bounce just as strongly as they've fallen so far this year. So I hope you found that useful. Thank you very much for listening to me today, and we'll see you again next time. Thank you.